Concerns about Canada's energy sector increased. Our next guest is actually very bullish on the shares of large Canadian oil sands producers. Dan Dreyfus is the founder and chief investment officer of equity hedge fund Bornite Capital and joins us with more. Previously at 3G Capital, the global investment firm behind Tim Hortons and Burger King. But you were not on the ketchup and donut file. You focused on industrials for 3G.
That's right.
I want to take you back to 2015. The Canadian energy sector was falling off of a cliff. Our oil prices were going for below $10. And it was at that time that you decided CNQ, Canadian Natural Resources, that was a buy at $24. The stock sold off, but then a couple months later and years later, it got as high as $45. It took, I imagine, a lot of courage to step in at that time. And now here we are talking about our Canadian energy sector. And it feels like valuations are depressed, if not more so, compared to that time. And it sounds like you're stepping in again.
Yes, I am. I take a bit of a contrarian view with respect to the oil sands because I don't really focus on pipelines coming on. I don't really care if the oil price goes up. In fact, I don't really care if the oil price goes down a little bit from here. What attracts me to them is just the quality of the cash flow stream. And let me explain. So at current oil prices, plus minus wherever the WCS spread is, they generate $9 to $10 billion of operating cash flow. Then they've got to spend $4 billion of capex just to maintain that operating cash flow. So we're talking about $5 to $6 billion of after-tax free cash flow, long duration. $5 to $6 billion of after-tax free cash flow on a $40 billion market cap. This is almost bond-like. Now, that's at today's oil price. Now let's talk about if oil prices go down. Well, we know that the U.S. shale industry has to self-fund right now. The capital markets are shut to U.S. shale. The days of issuing equity or issuing debt are long gone. At 55, U.S. shale can grow a little bit. At 50, U.S. shale has to stop growing. So we feel better underwriting a $50 oil price when we look at CNQ. In that kind of world, we're looking at a very high single-digit, approaching 10% free cash flow yield. Again, very long duration cash flow stream. Now let's look at the downside case. If we go down to 45, the marginal producer, which is U.S. shale, not only can't grow, but they have to decline. And so we feel extraordinarily comfortable underwriting $45. And at that price, a company like CNQ can more than cover its dividend. Its dividend is approaching 5%. So you're getting a 5% bond with really tremendous visibility.
There's so many people who can model out those same numbers or listen to you and say that makes absolute sense, and yet there still is this barrier to actual buying activity. Can you be right in your analysis and still be wrong in how the stocks ultimately trade because of things like pipeline capacity and sentiment and people just burned from the sector that are just never coming back?
So I actually like the fact that we're pipeline constrained because it forces these companies, it forces them to give you your money back. And so I look at it and I say, even if the share price doesn't go up a single penny from here ever, but just holds its value, I'm clipping 5% a year. Okay, and that's not great, but I know that that's a good case to underwrite on the downside. And 5% when we're living in a world of, 15, 16, 17, 18 trillion dollars of negative yielding securities, or the best one is the $1 trillion of negative yielding high yield securities. I mean, that's the ultimate oxymoron in finance. But clipping 5% with very long duration in a downside case, that's okay. Now, what happens if we start to exhaust the tier 1 shale inventory in the US? We have to move to tier 2. We know at 55 they can barely grow using tier 1. What if we exhaust tier 1, we go to tier 2, and now the floor price of the marginal producer goes to 60 or 65? Now, and that's going to happen in a few years. I mean, I think there's a lot of consensus around that view. Now we're talking about getting close to $13, $14 billion of free cash flow on a $40 billion market cap where they have to give it back to you, either dividend or share repurchase. So I don't see a scenario if you have an outlook, a medium-term outlook, where the stock can't re-rate materially higher in a world where oil prices don't have to go up much and where pipelines don't get approved.
I just want to get things right here. You are a foreign investor in Canada
Yes.
who just spent like 4 minutes building a very strong case for Canadian energy. So this argument that we talked about Jason Kenney, the Premier of Alberta, who was in New York just a few weeks ago making this case to Wall Street investors. This idea that foreign investors are fleeing Canada's energy sector. Doesn't sound like that's you.
Well, I've made my most money in my career zigging where everyone's been zagging. And when foreign investors are fleeing, that to me is a sign to dust off the files and come in. Some of my best investments historically have been made in Canada during times of extreme distress. Tech Resources back in the financial crisis in '09, when everyone thought they weren't going to get their bank facility renewed. I was at Goldman Sachs. We became a top 3 shareholder when the stock was trading at around $3 or $4 a share. And it went up 10x from that. And foreign investors were fleeing, domestic investors were fleeing. But if you do your work and just look at the cash flow streams, I think over time, that's how you get paid.
And so it sounds like rather than the narrative being incorrect that foreign investors are fleeing, it sounds like that is correct. You don't have a lot of peers south of the border who are probably saying, yeah, this is a good call. You're standing alone.
A lonely voice.
Is it easy to fundraise in that environment? I mean, I was talking to Ted Goldthorpe yesterday, who said it's one of the ironies of the best time to invest means it's the hardest time to raise money for that investment, because very few people are willing to throw money at you to fund a energy investment versus if you wanted to chase a tech investment.
That's very true. It's also the case that we're very fortunate. We have a very ultra long duration capital base with some really smart investors. And if we tell the story, generally I find it does stimulate people's hand to wallet reflex because it's so different and the cash flows are compelling.
With your history at 3G, we know them as a very involved shareholder, hands-on, gets into the nitty-gritty of the operations. With that as your background, and as you look to the Canadian energy sector, do you think that sector needs that, or executives are doing what they're supposed to be doing in this environment? I guess I'm asking is, should there be more activism pushing these companies in the direction that they need to go?
I'll tell you, the invisible activist is the lack of pipeline capacity, because that's the most powerful activist of all. It forces them to give money back to shareholders. We do not want these companies to grow. Look at the US companies. Anyone who kind of grows above cash flow, their equity values, their cost of capital is going through the roof. The fact that there's takeaway capacity constraints, which forces these large cap, long duration cash flow oil sands companies to give the money back to you, it's effectively a bond. And it's a bond when we're living with the lowest interest rates we've ever seen in history. And so I don't think there needs to be activists, and the management teams are doing the right thing, in my opinion.
So CNQ is one name. Do you have a couple of others that you're looking at?
We go large cap with good management teams. So I think CNQ tops the list. It's got the best valuation. It's got the best management team. They're owners of their business, and so they think like owners. That's what we did at 3G. We always like to think as owners, and they think like owners. And then I'd say second and third, tied for second and third, is Cenovus and CNQ. Or Cenovus and Suncor, sorry.
Okay. Dan, thank you so much for joining us with your perspective. Dan Dreyfus, founder and chief investment officer at Bornite Capital.